Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cadre Holdings Inc. Annual Report. Cadre Holdings Inc. offers a diverse range of products and services to protect users from hazardous situations. The company's product segment includes body armor, survival suits, bomb suits, duty gear, communications equipment, forensic tools, and crowd control products under various brand names such as Safariland and Protect Tactical. In addition to its own products, Cadre Holdings also distributes third-party items like uniforms, optics, boots, firearms, and ammunition. The company's distribution segment caters to a wide range of customers, including first responders, federal agencies, and foreign government agencies. Furthermore, Cadre Holdings provides specialized equipment and services for the nuclear, defense, and oil and gas industries. This includes designing, manufacturing, and servicing equipment, vessels, precision components, and remote handling systems. The company's expertise extends to serving various sectors such as law enforcement, fire and rescue, explosive ordnance disposal technicians, emergency medical technicians, fishing, wildlife enforcement, and departments of corrections. Overall, Cadre Holdings' offerings are designed to provide protection and support in high-risk situations, making it a critical partner for organizations that require specialized equipment and services. Cadre Holdings Inc. (CDRE) stock has experienced a significant increase of over 22.4% in the past year, with some reports indicating a surge of 31% and even a 38.06% rise over its 52-week period, reaching a new 52-week high. Several key news events have likely contributed to this positive stock performance. One major factor is the acquisition of Tier Tactical for $175 million in October 2025. This strategic move is expected to enhance Cadre's market position and has already generated significant revenue. Additionally, Cadre's subsidiaries have secured several significant contract awards, including 2 contracts worth a combined $86.4 million from General Dynamics European Land Systems and a 5-year ID/IQ contract with a maximum value of $50 million from the United States Department of War. Cadre Holdings' strong financial results and guidance have also contributed to its stock price increase. The company reported solid full-year 2025 results, with net sales of $610.3 million and record annual adjusted EBITDA of $111.7 million. For 2026, Cadre Holdings guided for continued growth expectations, projecting net sales of $736.758 million and adjusted EBITDA of $136.141 million. Furthermore, Cadre Holdings has consistently demonstrated a commitment to returning value to shareholders by increasing its quarterly cash dividend. The company declared a quarterly cash dividend of $0.95 per share in October 2025 and further increased it to $0.10 per share in January 2026, marking the 3rd consecutive year of dividend increases. Overall, these key news events have likely contributed to Cadre Holdings' stock price increase, driven by its strategic acquisition, significant contract awards, strong financial results, and commitment to returning value to shareholders. Cadre Holdings, Inc. market capitalization of $2 billion is materially smaller than most of its industry peers of roughly $6 billion. Cadre Holdings, Inc. trades at a higher price-to-earnings ratio of 37 times and a higher price-to-book ratio of 5.4 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 52% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be categorized into several key areas. Revenue growth drivers are primarily driven by technological advancements and refresh cycles on equipment supplied via the product segment. The increasing focus on safety, replacement, and modernization trends also contribute significantly to revenue growth. International expansion due to significant market share, opportunities, and investments in safety equipment are also major drivers of revenue growth. Additionally, strategic initiatives such as cost structure optimization, complexity reduction, and lean tools have a positive impact on revenue. On the other hand, revenue decline drivers are primarily driven by external factors such as changes in government funding priorities, fluctuations in exchange rates, and economic downturns. Uncertainty surrounding sustained revenue growth outside of the United States also poses a significant risk to revenue decline. Other drivers that contribute to revenue decline include geopolitical conflicts, tariffs, and trade restrictions. Overall, while there are several drivers of revenue growth and decline, technological advancements, international expansion, and strategic initiatives are key areas of focus for driving revenue growth. Net income and profit margins. A year of growth and adjustment, the net income of the company experienced a significant increase in 2025 compared to 2024. The net income rose by $7,906 or 22.2%, from $36,133 to $44,139. This growth was also reflected in an increase of $8 million from 2024 to 2025. However, the net income margin did not remain constant due to fluctuations in currency values. A 10% increase in the Canadian dollar value led to a decrease of $0.4 million, while a 10% decrease in the Mexican peso value resulted in an increase of $1.9 million. The profit margins also underwent notable changes in 2025. The overall profit margin increased by 22.3%, from 6.4% in 2024 to 28.7% in 2025. This growth was driven by a significant improvement in the product segment, where gross profit as a percentage of net sales rose by 137 basis points to 43.5%. In contrast, the distribution segment experienced a decline of 57 basis points, with its gross profit margin decreasing to 22% from 22.5%. The net income margin also increased from approximately 10.1% to 12.3%, while the adjusted EBITDA margin rose from around 13.2% to 14.1%. These changes demonstrate a shift in the company's profitability, with the product segment driving growth and the distribution segment facing challenges. The company's financial performance is a testament to its ability to generate significant operating cash flow. According to the provided information, net cash provided from operating activities stands at $63.7 million, page 41. Furthermore, the operating cash flow for 2025 is reported as $125,327, page 52, indicating a substantial increase in cash generation. The confirmation on page 80 that operating cash flows are positive in both 2024 and 2025 reinforces this notion. This trend suggests that the company's operations are generating sufficient cash to meet its financial obligations, positioning it for long-term sustainability. The company's debt level has undergone significant changes over the past year. According to the financial reports, the debt level increased by $309.1 million as of December 31, 2025, marking a substantial rise from previous years. This increase is also reflected in other metrics, such as an increase of $84.1 million and $83.517 million, further emphasizing the significant growth in debt. The interest expenses have also seen a notable change, increasing by 59.5% from $7.8 million in 2024 to $12.5 million in 2025. This substantial rise can be attributed to various factors, including changes in interest rates and applicable margins. The company's Canadian loan agreement saw an increase in the applicable margin range from 1.5% to 2.5%, contributing to the higher interest expenses. In conclusion, both the debt level and interest expenses have experienced significant increases over the past year, indicating a substantial change in the company's financial situation. The performance of various regions and segments has been analyzed based on the extracted summaries. Internationally, markets have performed well, with no specific mention of Europe's performance being noted. In contrast, U.S. federal government programs have struggled, while countries plagued by economic instability or hyperinflation have also seen poor results. Regions affected by conflicts, such as the Middle East and Ukraine/Russia, have also underperformed. On a more positive note, segments related to nuclear safety have excelled. Additionally, the product segment has shown growth in gross profit, increasing from $176,888 to $236,657 between 2023 and 2025. However, areas where local government policies are uncertain or poorly administered may be impacted, as well as countries subject to tariffs and trade restrictions. These regions will need to navigate these challenges to achieve success. Management is optimistic about the company's outlook, citing its leadership positions achieved through high-quality standards, innovation, and direct connection to end users. They expect demand for their products to be driven by technological advancements, recurring modernization and replacement cycles, and regulatory compliance. The market for safety equipment is stable and growing, with long-term opportunities, particularly in international law enforcement markets. Management believes the nuclear safety products market has a total addressable market of between $3 billion and $6 billion. To drive growth, the company will focus on new product launches, international market expansion, and targeted acquisitions. Management is committed to adapting to technological advances and changes in customer demand, investing in proprietary technologies, and balancing cost-effectiveness with innovation. However, they acknowledge potential risks and liabilities related to climate change, sustainability issues, and third-party cloud-based solution providers. The company's growth strategy includes increasing volume, improving manufacturing efficiency, and expanding e-commerce capabilities. Recent acquisitions have contributed to adjusted EBITDA growth, and management believes its cash flows from operations and cash on hand will be adequate to meet liquidity requirements for at least 12 months following the date of this report. The company has made significant acquisitions and divestitures in recent years. In terms of acquisitions, the company purchased Cars Engineering Limited, excluding Churton Engineering, and its U.S.-based counterpart in April 2025 for an undisclosed amount. Additionally, the company acquired Zircaloy for $98.9 million in the same month. Furthermore, Tier Tactical, LLC was acquired by the company in January 2026 for a total of $174 million. On the other hand, the company has also made divestitures to streamline its operations and reduce costs. Specifically, it sold off existing nuclear safety products, resulting in a reduction of $7.7 million in revenue. These transactions demonstrate the company's strategic efforts to expand its portfolio while optimizing its business model. The company has a history of paying dividends to its shareholders. According to the extracted summaries, the company pays quarterly dividends of $0.10 per share. The total cash dividends paid in 2025 were $15.4 million, which is an increase from the previous year's payment of $13.9 million. This trend suggests that the company has been consistently paying out a significant portion of its profits to its shareholders through dividend payments. There is no mention or indication of share buybacks in any of the summaries provided. Therefore, it can be concluded that the company's primary method of returning value to its shareholders is through dividend payments rather than buying back shares. There are valid concerns about inventory buildup and supply chain disruption in the industry. The procurement process for government contracts is highly competitive, which may lead to limited sources for raw materials and components, page 17. This scarcity can significantly curtail manufacturing operations. Furthermore, suppliers need to prioritize DPA orders may constrain product manufacture, leading to potential shortages from suppliers due to past experiences with DPA invocation, page 18. Extreme weather events and changes in customer demand can also cause supply chain disruptions, page 19. Temporary interruptions to certain operations are possible due to cybersecurity incidents, excess inventory resulting from delayed shipments, loss or corruption of data, and disruptions in operations, page 21. The increased orders backlog by $61 million as of December 31, 2025, compared to December 31, 2024, is a significant concern that may impact the speed of order fulfillment due to inventory on hand, page 37. The cost of goods sold increased by 5% in 2025, and distribution segment net sales decreased by 0.5%, suggesting possible supply chain issues or reduced demand for distribution services, page 39. Additionally, product segment cost of goods sold increased by $19.2 million due to increased volume and increased costs to manufacture product, which may be related to inventory buildup, page 40. The inventory levels have increased by $3.6 million in 2025, indicating a potential buildup, page 44. Moreover, concerns about inventory buildup are mentioned on several pages, including page 52 and page 65, where it is noted that there are increased levels of finished goods, work in process, and raw materials and supplies. In conclusion, the industry faces significant challenges related to inventory buildup and supply chain disruption. These concerns can impact manufacturing operations, product availability, and ultimately, customer satisfaction. That concludes the financial summary for Cadre Holdings Inc. Feel free to comment below, and I will be happy to answer them when possible.